Advantages in investment management come from better judgment, not better forecasts. The Investment Management Workshop at Harvard Business School Executive Education helps experienced investors strengthen decision-making in fast-moving markets. Through faculty-led case discussions and peer debate, you will examine how great investors think, assess risk, and allocate capital over time. The result is sharper insight and a more disciplined investment approach. Apply now to the Investment Management Workshop at hbs.me/investment. That's hbs.me/investment. Welcome to Compound Insights, podcast by CFA Society New York. I'm your host, Gary Farber. Today we're welcoming to the podcast Shirley Hu Anderson. Shirley is a portfolio manager and analyst at DSM Capital. She has substantial experience in the technology sector, where she has approximately 18 years from several different viewpoints, including the buy side, sell side, as well as investment banking with previous firms including AllianceBernstein and Credit Suisse. DSM has approximately $7 billion in assets under management and specializes in actively managed long-only growth portfolios ranging from sort of large cap to dividend growth, as well as newer strategies such as Runway and Expressway, where the focus is on growth and technology. Shirley, welcome to the podcast today.
Thanks, Gary. Pleasure to be here.
Given your length of tenure and diverse background in tech, Shirley, how, if at all, has investing in the sector evolved over your career?
So I've covered the tech sector now for almost 20 years, starting off in banking and then on to the sell side and various roles on the buy side. And I would say, going back 20 years, what's really changed is kind of in the early 2000s, it was a very horizontal tech stack. So thinking of the Wintel era, where there was a dominant tech company in each layer of infrastructure. If you think about Intel with x86 as the dominant silicon player and PC and server, you had Microsoft and operating system, you had Cisco, EMC, Oracle, and enterprise infrastructure, and so on. And then we really started to see that evolve maybe around 20 years ago when mobile and cloud were emerging themes, that the large tech companies were starting to move toward more of a vertical stack. So they were trying to own every piece of the stack from the infrastructure layer to the device to software and upwards to apps and services. And you now see the fruits of all that has occurred, where Amazon owns their own stack from infrastructure up, Microsoft, Google, so on and so forth, down to the silicon layer. In many cases, networking, servers, they all design on their own. And then I would say over the last year or two, we're really seeing the AI stack emerge and still trying to piece together how that might play out. So right now, obviously, NVIDIA is the dominant silicon software layer for AI with some challengers in there. They're strong in the networking layer, also with some challengers there. And then on top of that, the model layer coming from Google, Meta, OpenAI, and Anthropic. And actually, NVIDIA is here as well with their own open source model. And then, where we get a lot of focus today is on the compute layer, which is all the large hyperscaler players, including Amazon, Microsoft, Google, Meta. You might throw Oracle in there as well, where their blue chip status, their existing strong free cash flowing businesses are actually enabling them to capture advantage early on in the AI cycle. So they're able to sell this, quote, intelligence to other businesses and also turbocharge their own businesses. So not a lot of companies out there that can afford the level of spend to create this 100,000 GPU cluster. And that's kind of the layer where a lot of that is playing out right now. So we're watching closely how this AI stack will evolve over time. That's definitely where we're spending a lot of our time today.
And we're just exiting earnings season. Any key takeaways for the group, do you think?
Maybe two takeaways. The first is really how large some of the CapEx raises have been this earnings. First with Google, with a massive raise to their CapEx, Amazon as well. I think far exceeding what we had thought coming into the year. We were probably above 500 billion of CapEx among the big hyperscalers. That's now above 600 billion. So collectively, an additional 100 billion of CapEx spend. And it is interesting to kind of debate what might exactly be playing out. Obviously, they all see the need to spend. They see the ROI. You see all these businesses, very large revenue businesses, accelerating across Facebook, Google, Amazon. And a lot of it we think is some kind of signaling from Google that we're very serious. We're putting our money into these data centers and kind of challenging others to follow along and keep up. So I think one of the key focus areas is just the sustainability of this capex, and that's something we spend most of our time doing to underwrite our portfolio. How sustainable is the spend, which we can go into from there. And then the other main takeaway from earnings was really came out of TSM's earnings, TSMC, who makes all the silicon in their fab in Taiwan. I would say they also did a massive capex raise, and they are saying significant upside to spend over the next 3 years. This is the first time we've really seen them do this throughout this whole AI investment cycle. They tend to be very conservative. They don't tend to raise capex without talking to their customers, and really vetting the sustainability of demand. And so that really caught our attention as well, that, kind of reinforcing our view that we are still early in the build out of AI infrastructure. And it's more likely to be a multi-year sustainable dynamic, as opposed to, I think, what is currently priced in the stocks is, imminent decline of capex budgets. So that's definitely not what we're seeing.
And what about business models? Do you think, given that's the backdrop, are there some that are better positioned than others to monetize things like artificial intelligence?
Yeah, that is a very key question. Um, what we've seen so far is the winners tend to be businesses where you can invest in your own core business. So I think the two companies that have done this most successfully so far are Google and Meta. And you can see that in kind of the growth rates coming out of 2025, where Facebook's family of apps ad revenue has accelerated pretty much every quarter, from 16% starting the year to now growing this massive business 24% year over year. So they're really able to use AI to kind of turbocharge ad targeting, reels, and their ad stack in a way that's generating meaningful ROI. The other would be Google. You see Google Cloud also accelerating from kind of a 20% year over year grower to last quarter growing 48% year over year. So that's a massive increase in growth on not a small business. And in addition to that, because they have the silicon, their TPU, they're able to also expand their cloud margin quite meaningfully. From last year it was in the mid single digits, and they're exiting 2025 at a 30% operating margin. So we're seeing these businesses that have the scale, that are able to use AI on their internal core businesses to really accelerate them. And then maybe, I guess you're also probably asking on the model layer, how they're going to monetize that, I believe.
Yeah, yeah.
Um,
What are some? I think that's what some people are probably struggling with. How
yeah,
all the spending, who are going to be the winners to make money from this trend?
yeah. No, that's a very important question. I think one way I've tried to size it or think about it is for somebody like OpenAI with ChatGPT. Today, they are probably monetizing roughly 5% of their monthly users. That's the floated around stat that's out there. So 5% of everyone who comes to ChatGPT is paying. And the average ARPU is probably around $20 a month. That's kind of their first tier of pricing, and where most people are using their models. So we're at 5% of total users paying $20 a month. It's not a lot. There's actually a lot of consumer surplus in that $20 a month number, if you think about how often people are using it. For myself, it has increased my productivity so much that I would certainly be willing to pay a lot more. And I think there's still a lot of people who have not tried the paid version who are relying on the free version, which is probably a year behind in terms of how good the model is. So I think over time, as people realize that and are able to use it more in work, I hear a lot of people saying, I'm not allowed to use it at work. I have to use some version of Copilot. I'm not allowed to just go and play around with Claude or ChatGPT directly. But as these models keep getting better, you will certainly see that penetration of paid users going up far higher than 5%. I would think over the next several years, it'd be closer to 80%. And then as these models get better, also the willingness to pay should be getting better. $20 a month is pretty much nothing at this point, and you can maybe look at coding adoption as the fastest pace adoption in terms of what has occurred over the last couple months and even over the last year, where we've gone from 0% penetration of coders to 100%. Every single coder at every single company is using Claude Code or OpenAI's Codex. Everybody's using it and everybody's paying for it. And, there's many developers who are using multiple accounts to try to improve their productivity. So we're very early days. I think with the next round of models from NVIDIA, the Blackwell models, will see a huge jump up in performance of these models and intelligence of these models. I think it will really catch some people off guard potentially. And then, what we've seen happen to coding, you would think over time would infiltrate into other spaces as well. So that's kind of what's driving our view of it being very early days still.
And you just touched on a whole bunch of trends there. When you step back, in 2026, what will that roll up into as far as key investment themes? What do you think the high level themes are for investing in technology today?
For 2026, so I guess the first thing is we still think in terms of the AI infrastructure build out that we are maybe in the second or third inning. So we continue to like that theme very much. As I mentioned earlier, the supply chain is actively working to reduce bottlenecks. That starts with TSMC, with the CoWoS expansion, with 2 nanometer capacity expansion. So they're building out with visibility for the next 3 years because that's kind of their plan right now in terms of increasing CapEx. And we also think a combination of better models. We expect the leading labs to close massive rounds of financing, which has also been an area of debate. How are we going to finance all this CapEx build? We think a combination of private market raises as well as potentially IPOs this year will support the infrastructure build. And then, we have massive deferred revenue and backlog numbers at a lot of the major infrastructure players that have yet to be recognized. Arista, NVIDIA, Broadcom have all signaled strength over the next year and beyond. And our view is we're really building out the whole ecosystem with visibility through 2030. I think that's the lift that's being asked for from the power suppliers, from the silicon supply chain, from construction of buildings, and that's kind of what the hyperscalers are saying as well. So that's several years of visibility, at least through the build out of infrastructure. So that's probably the top theme that we're focused on. The second would be to your question around monetization is when are we going to start seeing more meaningful monetization and who will benefit? So we own a lot of the hyperscale players such as Microsoft, Meta, Google, Amazon. And to date, they have been very focused on building out shells, procuring the power, getting the silicon in place. And they've now had their hands on Blackwell for a little while, but those models have not come out yet. So Claude Code, which came out, the latest version came out in December on Opus 4.5 is the model, really got a lot of people thinking about, what does it mean that you now have an agentic coding tool that is as good, if not better, than most humans? And how do you monetize that? And Anthropic is growing revenue exponentially. So I think we'll just start to see more monetization from better models this year. and we like the large cloud players to play that theme. And then finally, I would say is just disruption. Who is going to get disrupted? The moves this year so far have been enormous on any name that has even a whiff of potential AI disruption. So all the software names are being sold down to multiples we never thought we'd see. A lot of these high-flying software names are now trading at what you would think are maybe value type multiples. Even some of the internet names, I would point to a Spotify, a Shopify, a Booking.com are being impacted as well in the view that agentic commerce or agentic tools could disrupt their entire business model. So our view there is, in terms of potential companies to be disrupted, are trying to be less exposed to some of those names. But after some of these moves, really kind of sorting through the rubble and seeing if some names have just been thrown out indiscriminately. And we've found some opportunities in names that are down that should not be. So that would probably be the third theme this year is, trying to find names where people are just giving up on entire sectors where some specific companies are going to hold in a lot better.
What about M&A? You've talked about a lot of situations here where it's sort of early days, but are there sectors there also that you think are particularly ripe for a new consolidation cycle?
Historically, I would have said possibly software. In the past, when software valuations have come in, we have seen private equity step up. This time feels a bit different because there is just so much unknown about the terminal value of these businesses. So I'm not sure we're going to see the same thing this time around. It will be interesting to see, though. There are some software names where it's been rumored Anthropic or even OpenAI might have interest in buying some of the assets and maybe incorporating it into their businesses. So that could be a potential buyer. Semiconductors, not a ton. There's been a lot of consolidation already in the space over the last decade or two. So I don't see anything particularly meaningful happening there now. There's always rumors that SoftBank is interested in certain assets. They were rumored to be looking at Marvell last year to kind of build out their data center silicon portfolio. But I think given where valuations are and given all the activity going forward, there's less probably in the public markets. There may be more on the private side where certain private companies are getting picked off by the likes of NVIDIA or other companies, but probably not a whole lot in the public markets.
And shifting to the macro, when you invest in the tech space in the current environment, are there any what are the key items that investors should focus on here? Is it interest rates, economic growth, capital expenditures?
Yeah, I think overall, these names should outgrow the broader macro. I think what you're seeing a little bit of early this year is a dynamic of AI lifting a lot of boats beyond just tech. And so, partially that and just broader economic growth, we do see a broadening out of growth beyond just tech this year. And so, I think some of the flows this year have moved into a bit more cyclical names. Maybe some of it is coming from tech. So I would say for 2026, it does feel like maybe there's some repositioning of portfolios into earlier stage cyclical names. In our portfolio, we own a lot of secular growth, a lot of tech, a lot of aerospace and defense. But we own some names which should be exposed to kind of an upturn in the industrial cycle. So Integris is a chemicals business we own that is very levered to leading edge semi spend as well as memory build out, and we think that will be very strong. But they also have 40% of their business that's levered to more industrial, automotive, um, mainstream semiconductors. And so there is an element of improving, broadening of economic growth that would be improved, that would be helping a company like Integris as well.
And now a word from our sponsor. If you work in investment management, you might want to keep this on your radar or share with a colleague. Harvard Business School offers a wide range of short programs for working professionals to refresh and reframe their thinking. One of them is the Investment Management Workshop, a 3-day in-person program held on the Harvard Business School campus in Boston. The workshop is highly interactive and gives you the space to step back from daily market pressures and examine how investment decisions are made in uncertain times. You'll also broaden your range of potential investment and allocation strategies. You will learn alongside a global group of peers and engage directly with HBS faculty who teach and research in investment management. To learn more about the Investment Management Workshop, visit hbs.me/investment. That's hbs.me/investment. Shirley, moving into portfolio construction, if the portfolio were technology focused, how would you think about allocating capital on a sector basis? What would a model portfolio look like for you?
I mean, given where we are in the AI build out, we really like the infrastructure winners still. And I think, one thing that sets us apart as a growth manager is we are very focused on valuation. And so what we see today is very strong growth ahead, very strong earnings growth ahead for the likes of NVIDIA, Broadcom, Arista, and they are trading at very, very low PEs, which to us signals people are very skeptical about the forward demand. And that's, of course, not our view. We don't view it as a near-term cyclical dynamic. We view it as a multi-year secular growth. So I think that's where we're perhaps more bullish than the average growth investor right now, just given where the multiples are. NVIDIA at 24 times, we think is not pricing in a whole lot of growth. So I would say a big portion of the portfolio I would allocate to the infrastructure winners, and we still think it's early days there. I think the second piece, I would think about the large cloud players, which similar dynamic actually are trading at lows of PEs, particularly a Meta or Amazon and even a Microsoft have been sold off on these large CapEx raises. And we think we're still extremely early on the monetization piece as well. So that we like, and I would make a large piece of the portfolio. And then thirdly, in our portfolio, we've been fairly small in the software names. In the internet names, we have some exposure, but there are, as I mentioned, very interesting companies that are being tagged as AI losers, where we don't think that is the case. So Spotify, has been a very high multiple name for a very long time. It finally came into our range because of all this disruption, and we were able to buy it around 30 times earlier this year. And so I think maybe the last third I would put into names that are just down, 20, 30, 40% in a month, where people are, it's getting sold off with a software ETF, or it's being classified as a AI loser, and we have a pretty strong view that that's not the case. So those would probably be the three buckets.
And you just touched on, Shirley, various valuation metrics. Can you discuss just the overall valuation approach into constructing the portfolios at DSM?
So we focus on next 12-month PE, a likely PE. And so what we look at is the expected earnings growth that a company will derive over the next few years. What we like to see is a strong top line growth with expanding margins driving a better earnings growth, at least in the mid-teens or so. And in terms of PE, we're looking to buy that stock when the PE is cheap to its historic levels or the fair valuation for that company. And so currently our portfolio is at 25 times forward PE, next four-quarter PE, and the most likely earnings growth for that portfolio is at 25%. And I would say also we do use PE to manage the position size. So NVIDIA is a large position for us. When the PE goes into the high end of the range, it typically has traded historically between 20 and 60 times. When it kind of goes toward that 40 times or above, we have trimmed it back. We've had a few opportunities last year where the PE compressed to 20 times. This was during the DeepSeek, the DeepSeek headlines, as well as the tariff-related headlines last year. We did have an opportunity to add to it at 20 times. So we do use PE as a means to manage our larger positions that we have long-term confidence in, but can sometimes price in a bit more hype or a bit more concern or fear.
What about qualitative factors in putting a company into the portfolio? When you analyze a tech company, how do you assess durable competitive advantage, essentially differentiating one company from another in the same space?
So qualitatively, we start with our assessment of the market opportunity. How large is the market? How fast growing is it? And we try to pick a good end market as the starting point. From there, we look at companies that either have strong market share or are gaining market share, or ideally both, but where there's some notable competitive advantage that is materializing in their share. And so the way we get confidence around that is we'll do expert calls, we'll speak with management, we'll talk to former customers or suppliers or employees, and get a better sense of what is really driving the share gains. From there, we also want to see a good management team, a quality management team that is deploying capital with a long-term horizon and are making good, positive ROIC investments. And so that would probably be the forward-looking view of quality. And then lastly, I would say margins. We'd like to see some signs of either pricing power or operational excellence where they are able to drive expanding operating margins over time as well. So rolling all that together, we should see a strong top line growth that we think is sustainable, and that driving also very strong earnings growth. So that's kind of qualitatively what we're looking for.
When you see a situation where maybe a company is sort of hyper growth or really crushing the estimates, does that make it more challenging to decide whether to sort of double down or take profits?
I think it is challenging in terms of how reflected it is in the valuation. So, names that are crushing estimates for a long time, often the PE will start to reflect that, and it will start to look expensive because people are pricing in continued just outperformance for quite a period of time. And I think maybe to your point, that's not always sustainable. That's not always the case. So I would say, maybe NVIDIA is a great example of that, where very early on they were doing massive beats and raises, and the PE did reflect that quite a bit. And so we did trim it back when the PE started to price in just continued massive beats. That's when we would maybe trim some off. And then our view is, going into 2026, they're as well positioned as they've ever been, and the numbers now look large, so people are maybe a little more concerned than they have been in prior years. But all the work we've done suggests that the forward growth should be very strong this year. Maybe they're entering another period of higher estimate revisions versus last year. And so when that occurs and the PE is low, we have had opportunities to add, but just trying to manage what is priced in, I guess, is the trickier part on the PE.
And you've touched on a lot of growth opportunities in this sector as a whole. How do you think about a company instituting, say, a dividend or even a buyback? Do you see that as possibly impeding innovation in a company, or is there some balance that you're comfortable with striking when a company does that?
We like buybacks. I think a lot of our companies do buybacks, and often uh, that can be a lot of our companies do it to offset stock-based comp related dilution. So that's kind of one thing. But some of them are actually very skilled at doing accelerated buybacks at good points in time and timing their buybacks well relative to the stock price. So we do like to see our companies do buybacks not only to offset the dilution, but just to um, uh, manage their cash flow well. Dividends we don't see as much. That's a little bit more of a sometimes you do wonder if is this a sign that maybe they're not seeing as much growth opportunity going forward. But for the most part, yeah, most of our companies are not big dividend payers in general. So we probably prefer that less to the buybacks.
DSM also has a runway strategy, an expressway strategy, which seem to have a technology bias. Can you sort of elaborate on those portfolios?
Yeah, sure. So we started Runway in late 23, and that portfolio was intended to kind of capture some opportunities that um, you know we were seeing where AI was broadening potential winners either down the cap spectrum or a bit higher PE than we would traditionally look at, and it's a higher name count portfolio. So in addition to who we think are the very best winners, including NVIDIA, Broadcom, and semiconductors, we can also own some of the other names that we think will benefit um, and um, not really just focus on the two dominant winners. So that has been a very exciting portfolio to be a part of, and ideally we're trying to also capture companies that can benefit from usage of AI as well as power, aerospace, and defense as well. So that has been exciting to be a part of. And yeah, I think um, our main advantage as a growth manager, or our main difference, I should say, is our focus on valuation. And a lot of growth managers don't really uh, potentially don't do that as much as we do, but trying to be a valuation discipline where there's 65% overlap between Runway and our large cap growth account, um, and uh, and also be able to capture some of the newer opportunities.
And what about risk management as you do that? Are portfolios stress tested, or is it really through position size and diversification that risks are managed?
Yes, I would say for Runway, it is mostly through position size. So the higher PE names, they are limited in terms of position size. Have to be under 2%. And there are a lot more, I would say, smaller positions as opposed to, having a 5% position in Palantir or something. So yes, we are managing maybe some of the higher PE positions by adjusting the sizing.
And what about the rise of the retail investor, particularly in this space, technology? Does that have much of an impact on sort of the behavior of tech stocks, do you think? Has it affected your ability or your approach in sort of building position in regard to valuation?
I think the entire theme of AI may be somewhat impacted by retail involvement. I would say maybe certain pockets of it. So, for example, nuclear, which is very, very early stage in terms of the development and adoption, we have seen pockets of retail involvement on names that are, pre-revenue, that may have, a good narrative where the stocks can stomach very long periods of hype. So that's probably not a name that we would be involved with anyway. But I would also put quantum in that bucket, where there are some very interesting teams and technologies out there, but they're all pre-revenue, pre-profit certainly, and so not a name for us necessarily, but where there is a lot of excitement from retail. So we do see that in certain pockets. Um, you do see in the AI theme, I would say Q4 last year, where you had some very vocal um, folks on Twitter, such as Michael Burry, writing up a bear thesis on the accounting at the large hyperscalers and why AI was unsustainable on that basis. I think that does capture a lot of attention from retail. He's a very smart guy, but we believe in that scenario his arguments are very wrong. And the pricing of NVIDIA's A100, H100 shows that demand far exceeds supply on even the older GPUs. Um, and so, we are mindful of things like that, where a single kind of influencer or blogger can move stocks. But we think they are probably doing a disservice in some ways to retail investors who are maybe not following the names as closely. So we think that has pressured some of the multiples and some of the names we own, but we do feel quite strongly that his arguments are incorrect. So yes, we do see some impact from retail trading around some of these names.
Anything else you think where there's sort of misperception or not or underestimation by investors in the tech sector today?
I think the number one thing is I think sentiment has swung way too negatively on the large cap AI infrastructure winners. I think that would be the top thing for me. And I think people look at the state of models today, they look at the state of monetization today, and they're not following the curve of the model improvement to the logical conclusion, where in a year we are going to have much more powerful models that people would be willing to pay a tremendous amount for beyond just coders, and the impact that will have on monetization, on what we should be projecting for OpenAI and Anthropic revenue, 3 to 5 years out, thinking through that, and what that in turn means for CapEx builds, because it is scary to see the giant CapEx numbers and just yell and say, it's not sustainable. There's no ROI. All CapEx cycles are bad. So I think it does feel like there is a lot of fear and concern. Meanwhile, NVIDIA just talked about their new Rubin platform a couple months ago, and the level of co-design they have to do across the entire supply chain, the willingness of hyperscalers to pay up for the best possible rack, the best possible system within a concrete power envelope. I think that is very underappreciated. So NVIDIA, I guess, pricing power and sustainability of that demand going forward, monetization going forward. I think that is still, I'm probably as bullish today as I was back in early 2023 when we were adding to NVIDIA. So I think that is probably the number one underestimation today.
Lastly, when you look out, say, 3 to 5 years, what do you think the key themes that investors will be speaking about or focused on in the tech sector?
One area that I'm very interested in and focused on right now is physical AI. So we did recently buy a stock that is going to have dominant share of the robotic arm at Amazon warehouses, where they're very early in adopting, but there's going to be increased penetration of their robotics arm throughout all of Amazon's facilities, and I'm sure they have other customers lined up as well. So I think thinking through maybe the next 3 to 5 years is, okay, now we have a lot of the infrastructure built, the models are improving, we have this you know, super intelligent um, data center, and what are we going to do with all this intelligence, and what is that going to mean for new products, cost structures. And so I think one interesting place is physical AI. The other will be how do these companies adapt in that environment. And right now, software is definitely top of mind because it really is the internal engineering capability at, say, a ServiceNow versus, I think the debate is, can a startup come in with 1/100th of the talent and because of AI be able to disrupt this company? So it'll be interesting to see how that plays out and who's actually able to move the quickest. And then I guess tangential to that is, you know, the maybe more exciting next piece of AI also will be healthcare. A lot of our semiconductor companies are talking about, you know, the first wave is currently applying AI to digital, and then it will be physical, and then it will be healthcare. And what kind of breakthroughs can we have on the scientific front, on the healthcare front, to really meaningfully improve people's lives, quality of their life with diseases or the length of their life. So that will be super interesting to see over the long term.
Shirley, thank you for your insights and valuable perspectives with us today. And to our listeners, thank you for tuning in to Compound Insights from CFA Society New York. We'll be back soon with more conversations with leaders in finance. Until then, I'm Gary Farber. Thank you for listening, and we'll see you again soon. Advantages in investment management come from better judgment, not better forecasts. The Investment Management Workshop at Harvard Business School Executive Education helps experienced investors strengthen decision-making in fast-moving markets. Through faculty-led case discussions and peer debate, you will examine how great investors think, assess risk, and allocate capital over time. The result is sharper insight and a more disciplined investment approach. Apply now to the Investment Management Workshop at hbs.me/investment. That's hbs.me/investment.